To the untrained eye, gold charts look like a mess of random fluctuations, but we can strip away that complexity by following a three-part mechanical system that resolves the market into a single, clean pathway. This approach relies on fixed rules for every decision. We define the specific entry point, the stop-loss level, and the target for profit before we ever commit capital to the market. You only need 3 tools to start: standard charting software, a position size calculator, and basic price candles. When we follow this structure, we move away from emotional guesswork and toward a process of precise, repeatable execution. The process begins by establishing the macro environment. Open the daily time frame to see the broadest view of the market's behavior. Our first task is to find major structural boundaries. Look for the highest peaks and lowest valleys, where price previously lost momentum and reversed. Next, we look for diagonal structures by connecting the lower points on the chart to form a trend line. To ensure these lines are valid for our framework, they must have at least 3 distinct historical touchpoints where the price respected the line. Now, remove any old, messy impulse legs from the chart. We only care about the clean boundaries currently containing the price. These levels represent the points where the market has historically hit a ceiling or a floor. Because they show where massive buying or selling occurred in the past, they act as the primary zones where institutional traders look to place their next high-volume orders. Once the gold price touches one of those daily boundaries, we zoom in. We drop down to the 1-hour or 30-minute time frame to find our specific trigger. On these lower time frames, we are looking for the formation of a consolidation range. A valid range shows the price moving sideways, trapped between a single resistance ceiling and a single support floor. Inside this box, buying and selling pressure is accumulating. The market is winding up like a spring as participants prepare for the next big move. This tight range is exactly what we need for a high-probability entry, because it provides a clear, narrow zone where we can measure our risk. Our signal to act is a clean breakout, where the price finally pushes through the top or bottom of that consolidation box. Directional bias is key here. At a daily ceiling, break out to the downside. At a daily floor, break out to the upside. Beginners jump in the moment price crosses the line. This mistake traps them in false breakouts that quickly reverse. To avoid this, we wait for our retest. We need price to pull back and touch the edge it just broke. Your entry should be placed at the extreme point of that broken boundary, either the highest wick of resistance or the lowest wick of support. Waiting for this retest provides structural evidence that the breakout has genuine momentum, which filters out the volatile noise that often traps aggressive traders. Before opening the trade, we have to define our safety parameters and our potential payout. The stop loss goes on the opposite side of our consolidation range. If price returns there, our trade thesis is invalid. To find our profit target, we look back at the 4-hour time frame, placing our goal at the next major horizontal structure. Measure the exact distance in pips between your entry and your stop loss. Use that pip distance to calculate your trade size. Every single trade should risk exactly 1% of your account balance. Finally, verify the risk-to-reward ratio of the setup. If the projected profit isn't significantly larger than the risk you are taking, walk away. We only take trades where the potential reward outweighs the cost of being wrong. Professional longevity in the gold market is built on these 2 rules: disciplined position sizing and strict ratio verification. By following this framework, you've moved from chasing price to executing a plan. You have a macro map, a micro trigger, and a mathematical shield for your capital. When the setup is right, the trade plays out with mechanical efficiency. Price hits the entry, holds above the stop loss, and moves steadily toward the target. Now, open your charts and look for these daily structural levels and micro ranges. Practice identifying these patterns in a demo environment first. Success in gold trading depends on the repetitive, flawless execution of this mechanical system until the process becomes automatic.